What makes this analysis different is one thing. I follow the money that moves before Western markets wake up. I am not here to alarm you. I am here to show you what the data says and let you decide. This video covers the $39 trillion debt story, what it actually means for gold, for treasuries, and for the structure of global money. Not the headline version. The version that institutional desks are quietly working through right now. Watch this fully. Every section matters. If you leave early, you will miss the part that changes how you read every market from here. In the last video, I said this. Gold would retest the $4,700 to $4,800 range after the sharp March pullback. I said the structural bid from Eastern central banks would prevent a sustained breakdown below $4,400. I said Western paper selling was mechanical, not fundamental. Here is what happened. Gold bounced from the March lows near $4,400 and has recovered to approximately $4,850 as of April 17, 2026. The retest happened. The bid held. The call was correct. I am not celebrating that. The record is the record. I am pointing to it because it matters for what I am about to say next. Here is the anomaly. The United States federal debt crossed $39 trillion in early April 2026. The Congressional Budget Office projects federal deficits will average over $2 trillion annually through 2036. The U.S. paid over $1 trillion in net interest expense in 2025, more than the entire defense budget. Those numbers represent an acceleration in fiscal deterioration that is without peacetime precedent. Now here is the paradox. The 10-year Treasury yield sits near 4.38%. That is historically moderate. Demand at recent Treasury auctions has been sufficient, not collapsing, not panicking. Fiscal reality is worsening at the fastest pace in decades. Treasury yields have not repriced to reflect it. That is not a glitch. That is information. The data needs to answer one question. Who is still absorbing $578 billion in new Treasury debt every quarter and why? And more importantly, what happens when that buyer's incentive changes? Let me give you the specific numbers driving this. The U.S. Treasury borrowed $1.9 trillion in fiscal year 2025 for new government operations alone. On top of that, Treasury refinanced $9.1 trillion in maturing debt through 444 separate auctions. That means the total gross financing requirement for the U.S. government in a single year exceeded $11 trillion. At the end of fiscal year 2025, gross federal debt stood at $37.6 trillion. By early April 2026, that number crossed $39 trillion. The average daily rate of growth over the past 3 years points to $40 trillion by late summer 2026. The cumulative deficit for fiscal year 2026 reached $1.2 trillion at the end of March, with 6 months still remaining in the fiscal year. The Bipartisan Policy Center's analysis shows this. CBO projects average interest rates paid on the national debt will exceed economic growth rates. Starting in fiscal year 2031, when that crossover happens, the U.S. enters what economists call a debt spiral. Deficits force higher rates. Higher rates increase deficits. There is no natural exit unless spending is cut or growth is structurally accelerated. That number deserves your full attention. There is one more specific data point from March 2026. A series of weak Treasury auctions raised alarms. Primary dealers, the institutions of last resort, in Treasury auctions took 24% of a 2-year note auction. That is roughly twice the normal share. The same pattern appeared in 5-year and 7-year securities. When primary dealers absorb outsized shares, it means natural buyers step back. Former Treasury Secretary Henry Paulson stated publicly that the scale of U.S. borrowing is severely testing confidence in the country's ability to keep financing itself. He warned that if enough investors back out of treasuries, the Federal Reserve would become the buyer of last resort, a dynamic that would erode confidence further. The Congressional Budget Office projects debt held by the public will swell from 100% of GDP today to 175% of GDP by 2056. These are not projections from fringe analysts. These are the CBO's own numbers. These are the GAO's own findings. These are the Treasury's own auction data. Price and reality are telling two different stories right now. Now I want to show you where Eastern and physical markets are pricing this differently than Western paper. Start with gold. Gold hit an all-time high of $5,594.82 per ounce on January 28, 2026. It sold off sharply through February and March, dropping more than 21% at its low, hitting $4,400 per ounce, which represented the steepest monthly decline in years. Western COMEX futures drove that sell-off. Leverage paper positioning, not physical demand, was the mechanism. Here is what the Shanghai Gold Exchange did during that same period. Chinese mainland gold ETF inflows reached 8.1 billion year-to-date through March 2026. Over that same period, U.S. gold ETFs saw over $2 billion in outflows. The direction was opposite. The magnitude was similar. Eastern money was buying what Western paper was selling. The People's Bank of China added 25 tons of gold in February alone. In March 2026, the PBOC added another 5 tons, its largest single-month addition since February 2025. That extends China's official gold accumulation streak to 17 consecutive months. China's total reported holdings now stand at approximately 2313 tons. That number is almost certainly a floor, not a ceiling. The PBOC did not update its reserve figure for 6 years between 2009 and 2015, then disclosed a 604-ton increase in a single announcement. Analysts who follow the Shanghai Gold Exchange's physical withdrawal data believe China's true holdings are meaningfully higher than official figures suggest. On silver, the divergence is more extreme. Shanghai silver is currently trading at a 13% premium over Western spot prices. COMEX registered silver inventories declined by approximately 1/3 from their September 2025 peak. London silver lease rates remain elevated, signaling low available float for 1,000-ounce silver bars. Meanwhile, Chinese SGE and SHFE silver bar inventories remain tight. The premium does not lie. Paper can't. This is not a technical arbitrage. Physical arbitrage between markets is constrained by PBOC, import licensing, transport costs, and regulatory controls. The premium is real. It reflects actual supply tightness at the physical delivery level. Let me be direct about what price is doing versus what fundamentals say it should do. Gold fundamentals in April 2026 are arguably the strongest in recorded history. U.S. debt at $39 trillion, a $1.2 trillion deficit through 6 months of the fiscal year, interest payments exceeding defense spending, a series of weak Treasury auctions in March, a CBO projection of 175% debt to GDP by 2056, central banks buying 850 tons of gold in 2025, alone the third consecutive year above 1,000 tons. Against this backdrop, gold at $4,850 is still approximately 13% below its January 2026 all-time high. Why? The mechanism is straightforward and does not require unusual explanations. On COMEX, most gold trading does not result in physical delivery. The majority of contracts are closed or rolled prior to settlement. This means price on the Western Futures Exchange is set by leveraged financial positioning, not by physical supply and demand. When margin calls hit, when hedge funds reduce gross exposure, when dollar-denominated risk assets sell off, COMEX contracts are unwound, price falls. The physical buyer in Shanghai sees the same lower price and buys more metal. That is not a manipulation conspiracy. That is the mechanics of how two different market structures interact. The consequence is this: Western paper markets can temporarily price gold below what physical markets are willing to pay. That gap is the Shanghai premium. That gap is the information. When it widens, It tells you the paper sell-off has disconnected from physical reality. The structural demand is not changing. The fiscal trajectory is not changing. Only the paper positioning changed in March, and positioning resets. Gold has risen 41.6% over the past 12 months as of April 17th, 2026. The S&P 500 is materially underperforming gold on a 12-month basis. Bitcoin is volatile without a clear directional trend. Why is gold leading? The comfortable reason is this. Gold is a traditional safe haven asset. With geopolitical tensions, specifically the U.S.-Iran confrontation of early 2026 that threatened the Strait of Hormuz and sent Brent crude toward $150 per barrel, investors sought protection. That is the accepted narrative. Geopolitical risk drives safe haven buying. It is textbook. The uncomfortable reason is this. Central banks are not buying gold because of geopolitics. They are buying it because they no longer trust the credit quality of U.S. treasuries at the sovereign level. By the end of the first quarter of 2026, gold and U.S. treasuries each represented approximately 25% of total global central bank reserves, excluding the Federal Reserve's own holdings. That is a symbolic parity. For the first time since the transition period after Bretton Woods collapsed in the early 1970s, the world's reserve managers have placed equal weight on physical gold and dollar-denominated paper. Those are not the actions of institutions hedging a short-term geopolitical event. Those are the actions of institutions repricing long-term dollar risk. The regime hierarchy right now is clear. Gold is the leading asset. It is leading because it is the only globally recognized store of value that has no counterparty. No government can freeze it. No central bank can print it. No sanctions can block it. Bitcoin trades the same regime narrative, but with leverage, volatility, and without the centuries-long institutional credibility that sovereign reserve managers require. That is why gold leads and Bitcoin lags in official sector flows. Size does not tell you direction. It tells you who controls the speed. The entity with the most size in this market right now is the People's Bank of China. Here is their incentive. China holds approximately $760 billion in U.S. Treasury securities as of the most recent data. That position has been declining. Simultaneously, China has been accumulating gold for 17 consecutive months. The motive is structural: reduce exposure to an asset that a geopolitical adversary can freeze or restrict access to, and replace it with an asset that is physically sovereign. The PBOC's buying has been described as clockwork, approximately 40,000 ounces per month added with no apparent price sensitivity. At $5,000 per ounce, that represents roughly $200 million in monthly purchases. That is not a trade, that is a policy. The second entity with size is the Western institutional investor via gold ETFs. SPDR Gold shares hit a record $160 billion in assets under management as of February 2026. Pension funds and sovereign wealth funds have been increasing gold allocation. JP Morgan projects 250 tons of inflows into gold ETFs for the full year of 2026. Now, here is the distinction that matters. The PBOC's buying provides a directional floor. It is price insensitive. It will not be sold based on technical levels. The Western ETF buyer is price sensitive. They came in when momentum was strong. They sold in March when momentum broke. They will likely return. This matters because direction and control are not the same thing. The PBOC controls the floor. Western positioning controls the speed of the move in either direction. When the crowd is most certain, the move is almost over. The March sell-off happened when Western certainty about gold as a one-way trade was at its peak. The crowd panicked. The floor held. That is the pattern. The level is $4,750. On gold spot, this is a lower bound of State Street's base case range for gold through year-end 2026. It is approximately where gold traded at the end of March before the April recovery. Multiple institutional analysts have identified this level as the line between a standard correction and a shift in the bull structure. Here is the bull case if $4,750 holds on any retest. JP Morgan projects gold averaging $5,055 per ounce in Q4 2026. The scenario where 0.5% of foreign U.S. asset holdings shift into gold generates enough demand by JP Morgan's own math to push gold towards $6,000 per ounce. If the Fed cuts rates once before year-end, as CME Fed Watch currently shows a 68% probability for real yields compress and gold's opportunity cost falls. Target on the upside, $5,500 retest by Q3 2026. Here is the bear case if $4,750 breaks and holds as resistance. Oil prices normalizing, ceasefire agreements holding in the Middle East, and U.S. economic data surprising to the upside could reduce the safe haven premium. A Fed that holds rates steady or signals a hike would strengthen the dollar and compress gold. State Street's bear case range is $4,000 to $4,750 with a 20% probability weight. If $4,750 becomes resistance, next support is $4,400. Below $4,400, the structural argument becomes harder to make near term. That is your binary. Watch $4,750. Now here is the case against everything I just said. Risk one, fiscal problems are priced slowly, not fast. Every serious analyst since 2010 has warned about U.S. debt levels. Every year the warning was directionally correct but temporally wrong. Debt spirals can take decades to resolve or accelerate. The Treasury market may continue to function adequately at current yields for years, longer than any model projects. Former Treasury Secretary Paulson and the IMF have both warned about declining safety premiums, but neither has predicted imminent collapse. There is a wide gap between deteriorating and crisis. That gap could be very long. Risk two, the gold price already reflects a lot of the bad news. Gold rose 64% in 2025. It hit $5,594 in January 2026. Even after the March correction, gold is still up approximately 41% year over year. A substantial amount of the fiscal deterioration, geopolitical risk, and de-dollarization narrative is already embedded in the price. Positioning is extended. When consensus becomes crowded, the reversal tends to be sharp. The March sell-off showed exactly what happens when leveraged longs unwind simultaneously. Risk three, the Fed still has tools and credibility. The Federal Reserve holds 8,133 tons of gold, 75% of U.S. foreign reserves. The U.S. dollar remains the world's reserve currency at approximately 56% of global foreign exchange reserves. Even after declining to a 30-year low, 56% is still dominant. The Fed could implement yield curve control to suppress Treasury yields if auctions deteriorate. This would not be costless, it would be inflationary, but it would prevent the Treasury market from breaking. Markets have repeatedly underestimated the Fed's willingness and ability to intervene. Risk four, geopolitical de-escalation, is the fastest reversal catalyst. The Iran ceasefire already cut oil prices over 10% in a single day. If a comprehensive U.S.-Iran agreement is reached, if trade tensions ease, if Middle East stability improves meaningfully, the safe haven and stagflation premium in gold contracts rapidly. State Street's bear case hinges precisely on this scenario. Oil normalizing to $80 to $85 per barrel could, in their words, send gold back above $5,000. But that assumes the Iran premium is the primary driver. If the debt premium is primary instead, that reversal is smaller and slower. You need to know which driver you are actually trading. These risks are real. They carry the same weight as the bull case. Anyone who tells you otherwise is selling something. 5. Structural facts that remain intact regardless of today's price. 1. The United States has added approximately $2 trillion to its debt every year since 2020. That pace has not slowed. CBO projects deficits averaging over $2 trillion annually through 2036. The arithmetic does not improve without legislative intervention that does not currently appear on the horizon. 2. Global central banks have been net buyers of gold for 16 consecutive years. The World Gold Council's March 2026 survey shows 68% of central banks plan to increase gold holdings in 2026, up from 62% in 2025. This is a multi-decade structural shift in reserve management. It is not reversible quarter to quarter. 3. Approximately 33% of U.S. publicly held marketable debt matures within the next 12 months. That refinancing wall is not optional. The Treasury must roll it. Every quarter that new debt is issued at higher rates than the maturing debt, it replaces the average interest cost on the total. Portfolio rises, a mechanical ratchet upward. 4. The dollar share of global foreign exchange reserves has declined to approximately 56%, its lowest level in 3 decades. This is a slow-moving but directional shift. It has not reversed since 2005. The Russia precedent, the freezing of $300 billion in Russian foreign exchange reserves in 2022, permanently changed how sovereign reserve managers assess counterparty risk. Gold became the only globally recognized reserve asset that is simultaneously liquid, widely accepted, and immune to foreign government interference. That perception does not change unless a new multilateral framework replaces it, and no such framework is imminent. Those 5 facts are the foundation. They existed before this week's price. They will exist after it. The open question I cannot answer yet: at what debt level and what auction failure rate does the Treasury market require the Federal Reserve to become a sustained buyer of last resort negative? And what does that moment look like in real time before anyone names it? I do not have that answer. I am watching for it. That is the unanswered question that will define the next decade. Follow me on X. The handle is Stanley Druckenmiller. That is where I post real-time data observations, auction results, and SGE premium updates between videos. I do not post for engagement. I post when the data moves. The urgency right now is this: we are approaching the next round of Treasury auction data in the coming weeks. The March auction showed primary dealers absorbing 24% of a 2-year note, twice the normal share. If that pattern repeats or worsens in upcoming 10-year and 30-year auctions, that is the signal that the fiscal stress is beginning to transmit into the funding market in a visible way. Watch those numbers. Do not wait for the headline. Be in the data before the headline writes itself. The $4,750 level on gold is your binary. You know the bull case. You know the bear case. The structural facts have not changed. The paper positioning has been reset. Eastern physical demand has not wavered. Don't follow the crowd. Follow the data. Stanley Druckenmiller out.